Hi there, and welcome back to the channel. Okay, some coffee is good. Okay, right. So, what we're going to talk about today? We're going to talk about the markets, the up and down, um, and how you should react in these circumstances. Now, unfortunately, what a lot of people do is they react the opposite way to what they should actually do to be profitable. So what happens is, if you see, I've got a little graph here as well. Okay, so what people do, they buy on the way up, and then because everybody else is buying, it's FOMO, what they call it, fear of missing out. So they buy as the shares are going up, the market's rising, everybody's happy, and then what they do, then the market, then people then have made money who've bought down here, and then they start to sell, and then the market starts to fall. Obviously, the market reacts to daily or weekly, reacts to events happening. So the market is from day to day, the market is up or down, up and down. But if you stretch out to the longer term, you'll actually see there's ups and downs, but the general trend is up. So in other words, if you're investing in the stock market, it should be at least 2 years and probably 10 years that you need to have the money put away, because if you need money in a year's time, then obviously the stock market is not the place to be, because it's not a savings account. You're investing in companies. So people forget that actually. You're actually buying a share of a company. So however many shares you buy, you own a little part of that company, and you share in the profits, you share in the dividends. So you share in the good fortunes and the bad fortunes. Okay, so that's what people do. But what you're supposed to do is actually buy here at the bottom. So in other words, like now, when everyone's panicking, what should you do now? There was a big sell-off. What should you do when there's a big sell-off? And the best thing to do is either nothing, or you start to buy. So in other words, if you've got, let's say you've got X amount, let's say 10,000 Rand or $10,000 that you want to invest. You don't have to invest all of it at once. You don't try and time the market. You can never get the exact bottom. But what you can do is you can phase the money in. So in other words, you can, instead of putting in 10,000, you can put in maybe 2,000, and then the market could rise or fall from there. Then you can put in another 2,000 in another week or 2 weeks or a month's time, and then you could do it like that and phase your money in like that. Then when the market goes up, I did say there's sell. So obviously that's the better time to obviously sell when the market's risen, because the market does move in cycles. But to be honest with you, the best thing to do is if you've got a good company, is hold it through all the ups and downs. There's some actually awesome companies who over the years have had what they call drawdowns. In other words, the price has gone down by 10, 20, 30, 40, 50% even. But over the longer term, they're up thousands of percent. So in other words, I know Berkshire's one of them, and Warren Buffett actually said it. I think he said since he's been there, they've had 3 drawdowns of about 50%. And yeah, no, I mean that's a top company which is diversified. It's almost like an ETF, but it's not a recommendation to buy. But yeah, no, but that just shows you that even a stock like that, Amazon has done the same. There's a lot of companies that's had drawdowns, but they've come back. And what you can do is obviously, like I say, you can actually, if you get drawdowns and stuff, if the best thing to do is have cash available, and you can buy some more. In other words, let's say you've got 100 shares, and then the price falls, and then you can either buy in like monthly, or you can say, right, okay, yeah, the prices come off. Okay, that's a great buying, because you know what, the stock market's the only place where everyone runs away from a sale. when when stocks are overpriced, everyone wants to buy in, and when there's a sale in the stock market, everyone wants to wait. Oh no, the prices are down. There must be something going on. Obviously there's obviously a war going on, and as soon as you heard there was a 5-day ceasefire, then the market actually the American market was up about 2% pre-market, and then 2%. Yeah, it was up over 2%, and then as news started to filter through that, there was obviously, I don't know if it's true or not, but Iran was saying no, they didn't, like whatever. But look, let's then the market fell, and the market was up about 1%, and then now today it's down. So yeah, the market's up and down, but always zoom out. Don't look at the thingy picture. These things like this is a buying opportunity. So always look for buying opportunities if the prices are down, because things are on sale. If it was a shop selling shoes, and you want to buy this share of this pair of tackies, or sneakers, or running shoes, or whatever you want to call them, different names, then you think, oh, okay, but it's a bit expensive. It's 1,000 rand for this pair of running shoes. Oh, it's a bit expensive. But if it goes on sale, and instead of 1,000 rand, it's 500 rand, then you'd be like, oh wow, okay, it's 500 rand. Yeah, let me go buy. But with stocks, people don't do that, and it's so strange. It's a psychology. I think the psychology of making money and losing money. If a stock goes up, people are euphoric. I think it sets off something that actually makes you happy, and if a stock's down, then it drops, which is strange because it shouldn't affect you like that. Because what happens is, so people are like, oh wow, I'm so happy, my portfolio is up 10%. And if it's down 10%, they're like, oh no, it's down 10%. What must I do? No, sell everything. So it affects us psychologically like that. So if you've got the mentality to say, if the market's up, if the market's down, it doesn't concern me. Longer term, the market will go up. You'll have bad news, you'll have good news. It always happens all the time. We had the tariffs, the prices dropped. It's a good buying opportunity. The market recovered actually quite quickly, which is surprising. But we have these drops and things. We have massive crashes, usually within a few months, sometimes a year, sometimes 2 years. But no matter how long it takes, the market will after a period of time hit new highs again. So the best thing to do is stay invested, especially if you've got dividend stocks, because you're getting your dividend. No matter if the price falls, your dividend yield goes up. If you buy more shares, obviously it's a higher dividend yield, but obviously your dividend, if you buy it and hold it over years, your dividend yield on cost will probably be quite high. The price will, because it's if as the price rises over time, then but what you need to do is you get your dividends. So you get your dividends 4 times a year, no matter what the market does. Most companies will still pay the dividends. So you get your dividends. You can reinvest your dividends, buy more shares, which will give you even more dividends. And as well, if the company increases the dividends, which a lot of companies do, they increase the dividend every year. Then you're gonna also obviously you're gonna get a higher dividend, and as well you buy more shares. So over time, it's like a snowball of increased dividends, increased amount of shares to give you even more dividends, and then it's you buying, and that's how compound interest works. You can obviously get compound interest on growth stocks as well, because they are growing your return on equity. If you've got a stock that's growing at 20, 30 or whatever percent, then it's reinvesting back in the company instead of paying out dividends. So it's growing like that, and then as they're reinvesting and growing the business, they increasing turnover and the earnings, and then the price will obviously go up as well over time. So yeah, so what I think is not financial advice. I'm not a financial advisor, but what I say is just keep at it. Um, yeah, you buy your shares, you know you're doing well. You keep on, and the market will have ups and it will have downs. Same as like we have seasons. We have sunny days, we have rainy days, we have a bit in between. But in the end of the day, it can't rain all the time, like they say in the Crow movie. Um, so yeah, we go through cycles. Same as the stock market. You think, oh, the stock market's down or whatever. If you look in a couple of years' time, the stock market, could have doubled by the end. It's so. Um, yeah, so the best thing to do is hold on and don't worry too much about the daily up and down movements of the prices. Um, yeah, like I say, you can, if the prices do fall, you can buy more. So, okay, so I don't want to ramble on a bit, but yeah, you don't let the market shake you out of your good investments. And over time, like Warren Buffett said, his favorite holding period is forever. So obviously, you will get to a time where you need to sell shares, but yeah, you can hold it till you retire, and you can still get your dividends. Then you can live off your dividends, or part of your dividends can pay part of your expenses. Okay, so keep on keeping on, and yeah, just don't stress too much. And then if you're paying in monthly, your dollar cost average, you're paying in monthly. If the market goes up or down, you don't even worry. You just pay in your monthly whatever, and then yeah, you set. So yeah, don't let it shake you. It's not easy. It's not easy, but I think like myself, I'm getting there with time. It's difficult sometimes, but I think I'm getting there. I'm now uh, more of a buy and hold instead of looking to get in or out the market and stuff. I rather buy and hold and add to my positions, as over time. Okay, thank you very much, and keep on investing.